Hello, everybody, and welcome to the Mouthy Money podcast. I am joined, as ever, by my keen as mustard co-host, Chris Tuite, Head of Consumer Finance at MRM. Chris, hello, good morning, or good afternoon, I should say.
Hi, Ed. Yeah, keen as mustard, absolutely. French or
We
English?
are, that's a good question. We are here to
Well,
discuss,
answer it then.
oh gosh, I don't know. I think it depends. Oh, this is taking us down an immediate rabbit hole here.
Okay, yeah, we'll come back to it at the end. You can think about it. Go on, let it
English,
percolate.
Bank of
English.
England mustard. That's what we're
Bank of
talking about
England
here.
mustard. Okay. Spicy
We
enough for
are
you.
We are here today to talk about one thing and one thing only, but trust me when I tell you it's very interesting and important in lots of different ways. We are here to talk about the Bank of England base rate and what is about to happen. So, Chris, do you want to give me the bullet? What's going on and what's about to happen? At time of recording, it's tomorrow, we will stipulate, in case you're listening to this on a Friday or Thursday afternoon.
Yeah, it's MPC Eve, and all in the house. Everyone's looking at their bills and hoping that the direction is down. No, we are. So yes, we do have the Monetary Policy Committee, Bank of England, meeting tomorrow to discuss the base rate of interest, which currently is at 4.5%. Everyone will know that that went up to try and stave off inflation. So usually raising interest rates quells demand and therefore has a dampening effect on inflation. The last couple of years, it's been questionable as to whether or not that's actually how things have turned out, but we have seen a general downward trajectory. However, the recent jiggery pokery that we've seen in global markets, tariffs, etc., have put pressure to stimulate. I think I saw it as, quote, withering consumer demand, where people are just suddenly feeling too pinched to do anything, and that's very bad news for a global for an economy like the UK and globally. So everybody is expecting the Bank of England to trim that rate tomorrow from 4.5% to 4.25%. And that means probably two things in the headline. One is, in theory, your mortgages should get cheaper, but it's more complicated than that. If you are looking to get a new mortgage, obviously, if you're on a fixed rate, then it will stay the same. And conversely, if you have savings in a cash savings account that's based around base rate, which most of them are, then the returns you'll be getting on your cash will be slightly reduced. There's lots of good reasons why we at Mouthy Money Towers are watching this with a keen eye, right, Ed?
Yeah, I think, looking at the kind of expectations and anticipation of what's going to happen with the decision, I think you would have to be pretty wide and outlier to not say that the bank's going to cut rates tomorrow. I think what's really interesting about it, and something that I've kind of returned to a few times in writing in the past few weeks on discussing it, is the fact that there's a bit of a mismatch here between when you look at what the core responsibility of the Bank of England's Monetary Policy Committee is and what is actually happening. So if you look at some of the forecasts, they were actually expecting inflation to go back up a little bit. Now, the MPC has one responsibility here, really, and that is to keep control of inflation, and it has a target of 2% that it has to stay on or around. In the past, and I remember in post-Brexit when we had inflation go above 3% because the pound devalued briefly. I remember the Bank of England governor had to write a letter to the Chancellor explaining why they'd screwed up so badly. I mean, fast forward to today, and we couldn't be in any more of a different situation where, plus 3% inflation is not that unusual. So things are sort of strange. But as you said, we've got this geopolitical, economic stuff going on, and that's put big clouds on it. And the phrase that economists and market watchers will use is the Bank of England are now looking through the inflation data. They're seeing through that data to what's going on in the wider economy and actually saying, well, inflation might not be coming down that much, or it might be not be slowing that much, but actually the state of the economy is a graver concern at this point, and we need to just kind of ignore it to an extent. That being said, one of the really interesting impacts of the past month of kind of turmoil has been that oil prices, which are a really, really fundamental component of what drives inflation in the UK ultimately, because it feeds into so much else. Think about transport costs, the cost of energy, all that kind of stuff. They've come down about,
Moving goods and services around the world has to factor in that as an
yeah,
overhead, right? It's massive to supply chains
all
and
of that.
how
Yeah.
this global economy works.
That's come down 18% in the past month to about
Wow.
$60 a barrel. So it's a significant price drop. People will be seeing that already at petrol pumps and that kind of thing. I've certainly noticed it. Filling up the car has been, several pennies per litre cheaper in a fairly short space of time. So I think it's pretty, with that in mind, it's pretty nailed on now that the government is looking at the economy, no, not the government, sorry, the Bank of England is looking at the economy and saying, we need to cut now. And I think, it would be pretty astonishing if they didn't at this point. I think what we're looking at is actually interpreting how many people are pro cut on the committee. So, are we going to get like a clean sweep of 9 people saying yes, cut? How many of them are saying cut by zero point 0.5 instead of 0.25, which is actually, a more extreme response. But yeah, there's so much to it as well. And we're going to look at, we're going to run through kind of the impacts. I know you mentioned there a bit of the personal side of things, but it affects businesses too, and it will affect the government as well, right? So let's start with how it affects households. You talked a bit about the mortgage side of things there. Do you want to give us a very quick rundown on the relationship between mortgage rates and why it's not quite as clean cut as kind of base rate bringing your mortgage down?
Yeah, we've touched on it before, haven't we? Because there's another variable. We'll start with the sort of the received wisdom that you'll see in the media and in other places, and when people talk about this, is that most providers take their pricing from where the base rate sits. So it's usually base rate plus a margin on top, which they will lend, which due to their own personal business circumstances will make it profitable for them to lend to people, and they'll assess risk in the background, the value of the property they're lending against, and all that kind of good stuff. Where it's a little bit more complicated is that some people some lenders of a certain size will get funding to lend money from money markets, which means investors essentially. And I'm not talking about, your bloke down the pub who can pick a stock. I'm talking about large organizations here that invest money to try and get a return on it. And, mortgages and property has been seen as a sound way of doing that. One of the variables, to put it very simply, that people who do that look at, and the people who are taking that money, will be a thing called swap rates. I do apologize. And that is, essentially the rate that they will set between each other for those deals, or the kind of base rate that they will set to ensure that when a lender receives money from an investment company or investment organization, that they need to lend it out above that in order to make profit. So whilst base rate and swap rates are intertwined to some degree, they are separate things. And so therefore, a base rate cut doesn't always mean that your mortgage will get cheaper immediately, because it depends how the lender is funding itself to lend the money to you. So that's one thing to kind of bear in mind. The other thing is that lenders are forward-looking, especially some of the larger ones, and will think about things like, how do we make sure we've got a market share? How do we make sure that we're getting as many people as we can to borrow money from us and still do it profitably and remain visible? Because mortgages are a long-term game, right? It's not, you sell a mortgage and kind of forget about it. You tie people in for 2 years, 5 years, 10 years in some cases. So they need to have that kind of longer-term view. And so some will have already priced in the expectation of these base rate cuts, because we are expecting this to happen for all the reasons you said, Ed, about the Bank of England looking through the inflation data. So when you consider that, you need to think about the individual circumstances of your provider, how long's left of your deal, all that kind of good thing. And it may be already that they've priced it in and they're already at a level where they're comfortable with it, or if more comes, others may follow suit. I think the important thing to remember here is that, broadly speaking, if you are a mortgage borrower, this has to be seen as good news. It does put a broader dampening effect on mortgage rates, and therefore makes the amount you'll be repaying monthly to a lender is likely to be more competitive. And when I say more competitive, those rates are more likely to sort of trend downwards over the long term, and there'll be more options for you to pay less, subject to all your affordability criteria and all those kind of good things. So broadly speaking, it's good news if you are in the market for a mortgage. On the savings side, the inverse is true, as we said. So, And from experience, painful experience, I know this to be true. It can take a little while for mortgage rates to come down, but the guys who are offering market leading savings rates, if there's a cut on Thursday, I think there's a safe bet to say that by Monday, that will be reflected in all of the cash savings rates that you've got. So if you've got a cash savings ISA, a cash savings account, just a general cash savings account, do have a look at what your rate will return down to, and then shop around, see if there's others. Because similar to the mortgage providers, those guys are looking to attract money in so that they can do things that they want to as well. And we'll try and make that as attractive as possible. But I would say base rate has a more direct influence on those rates in a faster period of time, and there's less variables compared to it is on your mortgage. But broadly speaking, good news for mortgage holders, and for savers, you might need to shop around a bit more to make sure you're getting the best kind of rate. Fair,
Yeah.
Ed?
Yeah, I think that's all super fair. On the savings side, I actually got an interesting email today from a business that tracks the kind of savings market called Money Facts, and they were kind of looking at the average fixed bonds rates, and they were warning that those fixed cash bond rates are kind of falling month on month. If I actually look at the little graph here that they sent through to me, I mean, stuff before rates really started going up, the averages were around 4%. That went way above 5% for most of the different kind of 1 year, 2 year, 3 years on savings rates during the kind of the 2023-ish, and then things have been kind of gliding down a little bit. So I don't think we're about to see like massive swinging cuts, but with the expectation now that things are going to keep coming down towards the end of the year, we could see stuff start to move downwards kind of precipitously. And then on the mortgage thing, yeah, and I get these emails through all the time from providers because they want to announce that they're cutting rates. They want to be seen to be cutting rates to get ahead of the market. You know, there's smaller, more agile ones like Empowered, who I know we had as a guest on the podcast a little while back. Get emails through from them all the time. They're right at the front of the cuts. But then, yeah, bigger banks are doing it as well, and that is more about trying to hoover up some of that market share, which, you know, is no bad thing if you're looking to remortgage. There is a price war going on. Things are hopefully going to be getting cheaper. I think from the standpoint of if you're looking for a mortgage, get that rate locked in as soon as you've got 6 months to go. We've talked about this time and again on the podcast. Get a rate locked in with your broker, and then just keep reviewing it, you know, as time goes on. Wait until your kind of last opportunity to do it, sort of thing, to make sure that you've got the lowest, the best rate you can for your circumstance. Again, you know, we don't give out financial advice on the podcast, so do speak to a broker about it because they will be best placed to help you where possible. Now, there is one slightly less talked about, perhaps, aspect to these rates coming down that I wanted to kind of discuss with you as well, Chris. Something which is a bit more difficult to pin down, but is really important and actually quite relevant to what's going on at the moment. I know from my own experience being a homeowner, having bought right when interest rates were about to start like shooting upwards, is that when interest rates come down or are at lower levels, that tends to be good for things like property prices. So I bought, to give you, I'll lay it out in pounds and pence with you. We bought our house for £285,000 in 2022, and I get the little monthly Zoopla emails. I'm
Me
sure
too.
lots of people, yeah,
Yeah,
I'm sure
it's been
lots,
up. It's up, down, up, down. It's been
yeah.
snakes and ladders, tiny little moves. Yeah,
I'm sure lots of people get that email because it's like a little bit of, I don't know, it's like a glutton for punishment opening it and looking at it every month. And I always forget my password. I'm like, God, I've got to go log back in and reset. I want to check the property price. Although I have absolutely no idea how 100% accurate it is. I'm sure Zoopla could come on the podcast and tell us if they wanted to. But yeah, like you say, at one point it went down quite a lot. It went down to like 278, and I was like, oh God. And then it's kind of hovered around the same sort of level, which when you compare that against kind of wage rises and that kind of thing, actually means affordability has been getting better. But what's interesting, and this bears out in data over years and years and years, when interest rates are lower, asset prices tend to go up faster. And that's because there's more money in the financial system. There's more money that doesn't have a home in those savings rates that we just talked about because they're low. The rates are low. They're looking for assets to get stuck into. So things like property does well. Equities tend to do better. Even the bond market does better. So the one bit of good news for homeowners, not for people who are looking to buy potentially, but the one good news for homeowners is that prices, this could help prices. It's not going to move the dial massively at this point, but it is perhaps going to, offer a little bit of relief. And that's also because interest rates come down, mortgages get cheaper. That means there's potentially more borrowers out there coming who are able to get onto the market, and that means there's more demand for, property demand is less suppressed. Basically, there's less people waiting it out.
Yeah, in theory, that if it gets cheaper to borrow, then there should be a greater supply of money, which means demand for those finite assets in terms of property will go up, and therefore that tends to drive prices in one direction. That's sort of the basic 101 kind of view on it, I think. So yeah, no, I think it's quite an interesting time as well if you're considering things like home improvements. If you're looking at adding that loft or that side return or whatever, which I know is a perennial question that I get asked by my wife, and I say not right now. Do you know how expensive it is to borrow? But if we see borrowing prices kind of come down, if you like, interest rates come down in that regard, it might stimulate more activity, and that's what the government are kind of banking on, right? Is to try to get things moving and to make consumers feel more comfortable about their wealth and therefore spending more and keeping the kind of economy moving. And that works for businesses as well, as you mentioned at the top of the show. So I hope it will have the desired effect. I am a little bit concerned about what you said, that they're kind of ignoring inflation now. It's just like, that's what it is now. Nothing we can do about it. Let's try this. And I suppose you do have to try things, and they have blunt instruments, which, are things like the base rate to try and move the dial on that. But yeah, it does. It just adds. I think it's a positive thing, but it kind of adds to this idea, well, we can't quell that, so don't worry about that. Let's do this and see what happens, rather than it being
Well,
considered in the same way.
yeah. This is kind of what I was going to come on to about how lower interest rates benefits businesses to an extent, but also the government, and I imagine that the government are probably waiting with bated breath to watch the interest rate come down, because it's good for the government debt, because it theoretically, although obviously there's a lot going on with the bond market and that kind of thing, it does help with things like interest payments and that kind of thing, and the
So this
amount
will help
of,
Rachel Reeves' fiscal headroom. Is that what we're saying?
not in a kind of like perfectly direct way, but it will help with that mix.
Yeah.
There's also another aspect to this, which is something I talked about ages ago on the podcast, which is a concept of financial repression, which something that actually happened after the Second World War, when we had a very high level of debt, which the government was really struggling to pay off. What they did is they let inflation run a bit higher than necessarily it should have been, while interest rates were kind of at a relatively low level. And what that does is basically devalues your debt, essentially, because it makes it look smaller as a, and that means that bondholders basically suffer because their bonds are getting less valuable. And there is an element of that at the moment, because inflation is conceivably going to be ignored at slightly higher levels than it should be. Although I think that the effect of that is perhaps going to be a bit more limited. But yes, the government will be able to sell fresh debt at lower rates potentially, unless it kind of the bond market throws a massive hissy fit. Which, now rates are coming down, not just here. It looks like they're going to come down in the US. They're going to come down in Europe. They're coming down in various different places in order to stimulate economic growth. Things conceivably are going to start getting a bit easier in that respect, although it's not going to really help any, the man or woman on the street kind of thing at the moment. But yes, it might help Rachel Reeves get 20 more minutes of sleep at night, perhaps.
Not directly, though. It's not completely self-serving. It's important to point that out. Like you say,
No.
it's part of a general mix of trying to improve the general conditions and get things moving, I think. But yeah, I think the point I made about kind of refurbishing and things like that I don't, I used to hear a lot about that and read a lot about that. People, how do you do this and what do you think about doing it? And that's just kind of not happened recently. Everything feels like it's been on hold with regards to that. So it still happens, of course, but not to the same degree, I think. And so, things like that can only really be a good thing if people can do it in a kind of financially sustainable way and they're not overextending and all that kind of good stuff. Then, that just creates more demand for construction workers, for the materials they need, for, decorating things, all that kind of stuff, and all of that does add up. And I'm not saying it's going to solve all our economic woes, but I think it's a good indicator of perhaps if that might just spark a bit more activity. We feel better when things are moving, right? When money's moving around and people are spending and stuff's happening, rather than sort of in this weird stasis we seem to have been in since the inflation crisis, really.
Yeah, yeah. I mean, look, this is a kind of a direct distillation of why we have interest rates at all, um, because when there's too much money going around, you have inflation. You know, prices of goods get more expensive, so you hike interest rates in order to dampen that demand, reduce the amount of money that's flowing around the economy, and then conversely, when things are going badly, you make debt cheaper in order to stimulate growth. You make it cheaper for businesses to borrow, cheaper for people to borrow, because they can then, take that 20 grand that they need to do their, loft extension or loft conversion or, whatever it might be. And that gives work to the builder, who then has a better time of it and can spend money down it all just kind of goes into the big old pie. I mean, I think one of the things that I think we're not going to go back to is, if you look at the 2010s, when we had rock bottom rates for a decade, pretty low and steady inflation as well, which is why we were able to sustain such low rates. But I think some of the consensus, and I don't know if it would necessarily be everybody would agree with this, but I'm of the view that actually those rock bottom rates weren't really very good for the economy ultimately, because it did stuff like it created a situation where businesses that were very unprofitable were able to take out cheap debt in order to keep themselves going, and you end up with what are called zombie companies, where they're basically providing no value, but they're keeping alive because they're able to access very cheap credit to keep themselves going. And this kind of thing, and it creates a lot of unproductive situations when rates are too low. You basically rates have to be at an honest level. They have to keep everybody honest, where you have to pay enough, in order for it to be to take a bit of pain, give you a bit of pain, but not so much that it means you just batten down the hatches and stop spending, which is what is happening now, and that is why we have to have a bit of relief to the situation. Thinking about, though, I mean, we've talked about the fact that we're getting pretty nailed on for a cut now. And the rest of the year, I think we're looking at potentially consecutive, more cuts coming down the road. I don't know if you have strong views of it, Chris, but do you have any inkling of where we might end up by the end of the year?
The speculation is that there'll be 4 cuts. So if we assume that it's going to be 0.25% each time, that means that we would be looking at a base rate of 3.5%. Now, there are more learned people than me who are better positioned to make that. I just read the speculation and bring it to you, Ed, and dear listeners. But I think, that feels sustainable. It's, to your point, it's not rock bottom like it was in the 2010s. Listening to you talk about that, by the way, a little bit of an aside, I bought my flat in 2015 and had a rate of 4.99%. So I never felt like I benefited from those rock bottom rates. And then, so actually my current rate is less than that. So it's been a bit weird journey for me. But anyway, there we go. So yeah, no, I think probably it will be around about 3.5%. That feels kind of sustainable, not too low. It all depends on your own personal situation. I'm talking from my own personal standpoint. That feels more palatable and doable, and therefore, I'm quite happy for that to be the case. I'm being selfish, and again, speaking in a kind of personal context. My biggest outlay every month, like a lot of people, is my mortgage. So if that's going to get cheaper, that frees me up to do other things, around childcare, around saving, around pensions, and then eventually, when we get through all of that, I might even stretch myself to, doing something fun. So we'll see. But
Oh my goodness.
yeah, exactly. Steady.
Chris Tuite admitting to splashing the cash. That's
we might
exciting.
have a full 50 quid left over every month to get half a Deliveroo or something. I'm joking. I'm not that bad. So yeah, I think that's where we're going to go. 3.5%. My mortgage is up in about a year's time, and if it was going the other way, I think I'd have very serious sleepless nights. So the idea that it's coming down is and that we reach something of a peak for now is reassuring. Just with other with other costs at the moment, like I say, 2 young kids and everything else like that. It would mean I'd have to change some aspects of my lifestyle to accommodate if it went the other way. So if it's coming down, that gives more headroom to do sensible things like put money in my ISA and my pension and then worry about what the markets are doing every day, Ed.
I'm going to go a little bit more bold than you, and we might have to review this in January, and you can make me eat my hat or whatever.
Let's write this down. You didn't eat it last time.
Well, look, so we got our mortgage. We got our mortgage in 2022 for the very reasonable interest rate of 2.99%, which is pretty
lucky you.
We were like the last chopper out of Saigon on the low rate,
clinging onto the guardrails of that as it flew off over the rooftops. I bet you.
And we booked, and I've mentioned this before, but we booked a 5 year. So I've basically just potentially ridden the entire interest rate wave and just missed out on the whole thing, which is probably the best decision financially I've ever made.
That's why you're the money expert, and I'm just some Joe who comes on.
I digress, Chris. I reckon we'll go to 3%, and I will give you a reason why I think we're going to go to 3%.
Talk to me. I love it. Talk to me.
I think we're going to go to 3% because I think that Rachel Reeves is going to put more taxes up by the end of the year. Right. And I think that the more pressure that the economy is put under fiscally because the government is struggling, the more the Bank of England will see that it needs to take pressure off. So I reckon I'll give it another 50 basis points on your prediction and say that I think we might be in for some tax rises come October. And I think we'll get a couple of last-minute cuts in order to compensate for that. Because I think fiscal and monetary policy, there is an element of them having to kind of balance each other out. So, and I can't see a situation in which we're going to get tax cuts or where things are going to stand still, because you just look at all the stuff that's coming through the system, and they've missed all their borrowing targets and that kind of thing by 20 billion or something like that. It's almost an inevitability at this point, I think. So we will see.
So what you're saying is cancel the Deliveroo. I'm going to be paying. I'm going to be paying it in tax. Is that what you're saying?
Yeah, just wait a while and don't get it on buy now, pay later, because you never know what's going to happen. Basically,
okay.
I think that just about wraps us up. I think we've set our tools for the end of the year. We're going to have to wait on those predictions a little bit. I think it'll certainly be interesting. I shall be reading the monetary policy report, and we will be putting a little bit of an update on Mouthy Money tomorrow for our newsletter. So do please give us a subscribe and check out the site in order to keep up to date with that. That's about it. Chris, thank you so much as ever.
My pleasure. Thanks, Ed.
And thank you everybody for listening. We will see you all again very soon, hopefully. Thank you and goodbye. Thank you for tuning into the Mouthy Money podcast. Don't forget to hit like and subscribe on all our content. Follow us for more on your preferred podcasting channel, including Spotify, YouTube, or Apple Podcasts. Stay in touch by following our social channels on Instagram, TikTok, and LinkedIn. And don't forget to subscribe to the Mouthy Money newsletter on mouthymoney.co.uk. The Mouthy Money podcast is produced for general informational purposes only. It should not be construed as investment, legal, tax, or other forms of financial advice. If in any doubt about the themes expressed, consider consulting with a regulated financial professional for your own personal situation. Past performance is no guarantee of future results. Investments can go down as well as up, and you may get back less than you started with. Never invest more than you can afford to lose. For more information, visit fca.org.uk/investsmart for more. Thank you.